Howdy, Jacob here. Today we're going to do a deeper dive on DXC Technology in the IT services industry. Reminder that everything I say will be of my opinion. Do what you want with it. Although this is a deeper dive, this is not an end all be all. Our initial analysis looks essentially at the price that it is today to get a 15% return. So I'm going to review the financials again to give everyone a reminder about the business. And then I will be going over some things that I took from the most recent quarterly reports and 10K and coming up with my new assumption based on that. Again, this is not the end all be all. Even if it looked like a good price at this point, I would want to do a deeper dive and look at relative companies that are similar to it in their business, their competitors, and be able to come up with a final valuation at that point before purchasing the company. So again, let's do a reminder of the business. They provide IT services and solutions in the US, UK, rest of Europe, Australia, and internationally. They operate business global services and business infrastructure services, founded in 1959 out of Virginia. Their revenue growth is up from 10 years ago, but since 2018 has actually gone down every single year since 2018. Gross margin is also lower than it was 10 years ago. Operating margin is having trouble grasping positive earnings, and they stopped paying a dividend in 2020. They do not have money going to R&D. Their balance sheet has 1.2 billion cash on hand, 93 million short-term debt, 3.6 billion long-term debt. And we can see that there's a big sell-off of acquisition, a devastation in 2021. Their free cash flow still looks like it's producing a lot of free cash flow. So again, even a declining business from a revenue standpoint that's producing free cash flow absolutely deserves a price. If I'm going to pay you $10 today, $9 a year from now, $8 a year from that, $7 a year, it's declining, but you're still getting free cash flow. Would I pay $10 for that business? Probably. Would I pay $1? 100%. Would I pay $100? Probably not. And so again, there's a price point for positive free cash flow businesses that makes sense. And so that's the quick analysis of the business. Now let's look at some of the points that I took from their quarterly reports, 10K. So they are down over 5% year over year in total revenue. And then on an organic basis in the most recent quarter, that's tough. That is big revenue decline, and that is organic revenue decline. That's not devastations holding your decline. That is apples to apples comparison. They are guiding revenue for the full year down between 4.5% and 5.5%, but free cash flow, $550 million. They report EBIT instead of EBITDA, which is a measure commonly looked at by Joel Greenblatt. I know between businesses, depreciation and amortization can be tough. So one of the important things that he looks at is earnings before interest and taxes, which can be more comparable across businesses. And I think that's a more comparable measure and a more appropriate thing to look at, as Charlie Munger and Warren Buffett have in the past, I believe, both called this Bush League earnings. They paid a dividend from 2018 to 21, but suspended and continue to have no intention of paying one in the near future. They have no geographic regions that had positive year-over-year revenue from 2022 to 2023, with UK just down 0.1%, but it's still down. All their geographic regions are down. Australia was down the most at 13% year over year. So they are not grasping any sort of positivity from a revenue growth perspective from 2022 to 2023. Cost-cutting strategy holds as costs and expenses are down 11.5% year over year. So again, they're making less revenue, but they're also cutting costs so that their earnings and free cash flow can stay consistent or possibly even go up. But again, there's only so much you can do that until you have no cost, no expenses, and you're not going to be making any revenue. They have 1.2 billion in cash equivalents, 0.1 within the year, 0.7 billion in 2026, 0.7 billion in 2027, 0.8 billion in 2028, 0.6 billion in 2029, and 0.6 billion in 2032. So they have a good amount of cash on hand, enough for the next almost 2 years. But their production of free cash flow is in the roughly $500 million range. So that means that on top of that, I mean, they're going to have to be putting a lot of their money of free cash flow going to debt reduction. Um, Although they'll likely refinance some of these, they're still going to have to be putting a lot of capital allocation to debt reduction. So depreciation and amortization are massive, which causes their free cash flow to differ heavily from their net income. Their capital allocation of the last 3 years is 61% share repurchases, 59% debt reduction, 1% net sell off of assets. So again, not this capital allocation won't always equal 100% just because um, their cash can also change from start to finish. And so this isn't, as we can see here, it's greater than 100%, meaning that their cash balance went down from the beginning of 2021 to the end of 2023. But again, most of this money is going to share purchases and debt reduction. So with my new assumptions, I assumed 0% revenue growth. I think that was extremely optimistic given the fact that their year-over-year revenue decline has been consistent since 2018 and has been anywhere from as little as 4.5% to as much as 11%. And so I think 4% seems like they sold off all their poor assets. They're going to start, not making more, but I think this is tough. I think assuming 4% revenue decline year over year for the next 7 years is a tough thing to venture. Um, and I mean, again, if you're still producing free cash flow, you can still have a price. So again, I have a 7 on their P, price to free cash flow. Still looking for 15%. I'd probably look for even higher because again, it's a declining business and it needs to fall in half. So my initial assumptions, I think, were a bit frothy, a bit on the fiery side, which I just don't see being the case given this heavy decline since 2018. And I'm not seeing anything that's going to, really change it around at this point. So we're going to have, a good amount of money going to debt reduction, a good amount of money going to share repurchases. That's pretty much the capital allocation in these assumptions. And so again, it needs to fall pretty much in half before you get the return I look for here. I think there's other companies that are, better. So I'm not going to do review on their other competitors just yet. But if it gets to a price that makes sense at this price point, I'm definitely going to be looking at competitors and doing a final review of the business before purchasing the company. Hope you enjoyed this video. Have a great day.